You've worked hard to earn and save. Now it's time to make your money work hard for you. This is Empower Your Retirement with Frank and Frankie Guida of A Better Way Financial.
By the time you get to retirement, you might think, I've paid enough in taxes. Well, there are still tax traps that can get you even in retirement. And so it's important to have a plan in place to protect yourself from these common tax traps. We're going to cover 5 of them here. The first one is thinking Social Security is tax-free in your retirement. And this is a big one because this is the only place I've seen in legislation where you actually get double taxed. You get taxed when you put the money into Social Security, and you get taxed when you take the money out of Social Security, depending on your income level. And so this is something that most people think, well, I get taxed on the way in, I'm not going to get taxed again on the way out. But realistically, that's what happens for most Americans. Most Americans have to pay taxes on their Social Security. And so this is something that if you don't have a plan to see, all right, well, what is my net going to be after the Social Security taxes, then you might not be able to get enough income. So you want to have a plan in place to be able to protect yourself from that Social Security taxation. It's a very low income amount that can cause your income to be up to 85% taxable. It's somewhere around $42,000 if you're a married couple, that after you're over that amount, then your Social Security can be up to 85% taxable. So this can be a huge tax trap going into retirement. Now, one of the things that was passed was that One Big Beautiful Bill Act, or OBA, that did cause less people to have to pay the taxes on their Social Security because of the larger standard deductions, but there still is taxes on those Social Security incomes if you're over a certain income threshold. They look at things like your IRA distributions, your pension income there. Like even look at tax-free municipal bond income, which is supposed to be tax-free. It can cause your taxation on your Social Security to go up as well. So there are things that you want to look at. That's a common tax trap. Another one is required minimum distributions. Guys, this is one of the biggest tax traps that we've seen across retirement. And if you don't have a plan for how to protect yourself when those required minimum distributions come in, then you could be paying a lot more in taxes than what you feel comfortable with or than you even expected in your retirement years. For instance, if you're in your 60s and you're thinking, well, I got to wait 13 to 15 years before I have to start taking out those required minimum distributions. Well, that gives you 13 to 15 years to allow your money to grow. And if that money is pre-tax in 401ks and IRAs like it is for most Americans, that becomes a tax problem that gets extrapolated over the course of your retirement years. Once you hit age 73 or 75, you have to start taking that money out of your 401ks and IRAs to the tune of right around 4% in that first year. And that percentage keeps on going up every single year throughout the course of your retirement. So every single year, you're having to take out a higher and higher percentage from your 401k and your IRA, causing you to have to pay more and more in taxes because that money's never been taxed over the course of your working career. And so now you're at a position where you have to take that money out and pay the taxes on it. And that can be a huge trap if you don't have a plan to protect yourself from it. Another one is that IRMA, that Medicare surcharge that they have for the taxes. It's not really a tax, but it's like a stealth tax, where if you make a certain amount of income, Medicare says, oh, well, you got to pay more for my Medicare. Now, what are those brackets that you need to stay under? Well, if you're under $109,000 in 2026, is where you don't have to pay any of that IRMA as a single filer. If you're married, it's right around $218,000. That if you're under that, then you don't have to pay any extra on the Medicare surcharge tax there. So that's something that you want to keep that in mind, because if you are doing Roth conversions, or if you are getting income from your pension, Social Security, required minimum distributions, IRAs, these can affect whether you're going to pay that extra surcharge or whether you're not going to. So it's a hidden type of tax that most people aren't even thinking about going into their retirement. And this is really only going to occur after age 65. So if you're before 65, you don't really have to worry about it yet. But once you hit 65, this is something that can affect you. Additionally, people don't factor in that this can actually be affected once you get hit with those required minimum distributions, because that can then push you up over a certain threshold where now you have to pay that Medicare extra charge as well. So these are things that all factor in together. Another one is poor withdrawal sequencing. So you want to make sure you're taking from the right accounts at the right times in your retirement. Otherwise, you could be paying tens or even hundreds of thousands of dollars more in taxes than you otherwise would be if you take from the right accounts at the right time. So traditionally speaking, this is not a one-size-fits-all. We usually take from the non-qualified accounts first. Those are those after-tax monies that you saved into the bank and later invested, then shift over to the 401k and IRA assets, and lastly, touch the Roth IRAs. Ideally, you want to let the Roth money grow tax-free as long as you can, because if you're taking from that Roth first, you're having that IRA money grow instead of the Roth money. And by doing that, that's just further exacerbating the taxes when you do take out that IRA money in the future. It also makes a more tax inefficient legacy as well, because when your kids are inheriting IRA assets, they're paying taxes, whereas with the Roth IRA, they don't have to pay any taxes. And so it's very important where you take that money from. And you also want to look at when is the best time for Roth conversions. I was just talking with a client this week about what we can do to make sure that we're taking from the right accounts as far as when we should be doing these Roth conversions, when we should be doing Roth contributions. He and his wife were higher income earners. They were making around $400,000 this year, but once they retired, their income was going to shoot down to right around $100,000 to $200,000. And so I said, you guys are currently contributing into your Roth portion of your 401k, but your taxes right now are going to be higher than they're going to be in your retirement years. And we looked at their tax picture over the next 40 years. In their particular circumstances, it made more sense for them to contribute pre-tax now and contribute Roth or do Roth conversions after they retire when the income goes way down. This way they're locking in taxes at lower tax rates instead of the higher tax rates that they're at today. So when you do these Roth conversions matters. When you do the Roth contributions matters. These are the things that you want to look at. When is that right window? That right window for most folks, it's between retirement and the time that you start taking required minimum distributions. This also factors into Social Security because Social Security can count as income as well. So if you defer that Social Security, that can help with that window as well too. But even for some folks, it makes sense to do it during their working career as well, depending on where their income is at. So that's why it really helps to have somebody who focuses on that tax planning, looking into your specific circumstances and seeing, well, what can we do to make sure that you're paying the least amount in taxes over the course of your retirement year? So know what adds to your retirement income, what adds to your taxable income, how it affects your withdrawals, how much do we have to pay in taxes on various different accounts. And before you make a move, whether it's doing a Roth conversion or a contribution or whatever it may be, ask yourself, is this going to raise my taxes or my Medicare premiums? Or what are those thresholds? Is it going to affect my OBA extra deduction that I get there? Or how is that going to affect me short term this year and then also long term over the next 30 to 40 years? These are the things that you want to know. These are the things that you want to plan for in your retirement. So quick recap of all these things. Know what adds to your income in retirement, what actually is taxed and what those different tax rates are. Also, don't wait until the IRS forces you to take out your required minimum distributions. Start to make a plan now. And as you make that plan, think about, how is this going to affect my taxes now in the short term and then also in the long term as well? And if you need some help as you're trying to figure this out and trying to make sure that you're planning for and saving as much as you can in taxes, go to abetterwayfinancial.com and we're going to be able to start that conversation with you, or click on the link below.
Thanks for listening to Empower Your Retirement with Frank and Frankie Guida. To learn more, visit abetterwayfinancial.com.
By contacting us, we'll review aspects of your retirement portfolio to include suggestions about how best to utilize estate, tax, and retirement planning strategies and other financial services, or if changing management styles is appropriate for your specific needs and objectives. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendations to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. A Better Way Financial is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company. Any client experiences discussed during this show are unique to that client, and they are not meant to imply or suggest you will experience the same results. Advisory services offered through A Better Way Financial. Insurance offered through licensed professionals at A Better Way Financial. Pennsylvania Insurance License number 301779.